My name is Jeff Campbell. I'm, as Tony mentioned, a senior manager at Eide Bailey. And my focus is primarily going to be on really kind of what we're seeing out as we do these loan reviews. Dana touched on it earlier, and we're seeing more and more of that requests coming in, and both from the bank's perspective, which is a proactive approach, but also we're seeing it from a regulatory perspective, some of those expectations that they want to see, kind of those another set of eyes looking at some of that kind of information. So I guess what I'm going to kind of share with you is just what we've experienced as we've been out at your banks or at the banks that we've been to, and talk a little bit about some of the things that we're seeing in that regard. Oh, by the way, your for CPE, the check-in code is tractor. Anybody that's needing the continuing ed. And don't let me forget to give them the checkout code. Suppose if I gave that to you now, you'd probably leave, huh? Kind of to kick this off, you know, as we have a process that we've used for some time now as it relates to really looking at credit and doing it kind of based around really from a risk perspective and risk rating perspective, and whether or not based on our analysis we're concurring with what it is that you folks are experiencing from a ratings perspective, or as you're rating these credits. And I think we all heard it here a few minutes ago with the regulators. Those areas for the most part over the last few years have been well identified, but I think that challenge is in, when you start talking about risk ratings in your policy, and those risk ratings vary we see them from 1 to 5 in terms of a numerical system, to 1 to 8 or whatever, but 1 to 4 typically are going to be pass rating, or 4 may be a watch, but the reality is that, that question of whether it's a 3 or a 4 or maybe a 5 and falling into that special mention area, I think is part of the challenge, as we've seen the kind of restructuring that's been going on over the last several years to help these guys create some liquidity and some cash flow. So anyhow, as it relates to again, some of the things we're seeing in the field, the credit presentations that we're seeing, or the annual reviews. Oftentimes those are programs that are being used, whether it be something like Web Equity or others that are out there. And for the most part, there's a lot of good detail in there. We do see a couple of instances, or have seen, where I think there's a couple areas that we have brought kind of to the attention of the organizations, and one in particular with regard to debt service. We know that cash flow, operations haven't been cash flowing for the last 3 years, but what we see is in the debt service, as those spreads are being done in those credit presentations or those annual reviews, is historical debt service hasn't been included. So the only thing that's kind of showing up in those is whatever's showing for the budget. And I don't know that I've run across any budgets that haven't cash flowed. Unfortunately, that's not the reality of the world we're in today. So having information that's provided relative to historical debt service is helpful in not only identifying, obviously where the trends have been the last few years, but as those trends, whether they improve or continue to decline, it's helpful to have that information included. So that's an area that, again, we've had some conversation with some of the banks we've worked with, where that historical debt service hasn't been included. It's not being carried forward into those current credit presentations or annual reviews. Another area that, and I think about this from my banking background, and hearing from a regulatory perspective, when they come in, the narrative around that relationship, whether it be in a credit presentation, an annual review, or even file comments. But I just go back and think to the fact that they would talk about that they're not familiar with that customer. Your loan officers are familiar with those customers. You're familiar with them. So At times it can get to be almost an assumption that people know about that relationship, and the reality is that somebody new to that credit relationship that's picking it up for the first time is looking at it from, you know, a different perspective, a different lens. And so having good narrative within your credit presentations and annual reviews is helpful for you know, for that third party, whether it be an examiner or whoever, or somebody else looking at it, to help identify and get a sense of what that relationship is like, the background of those customers, and just oftentimes in those annual reviews or those credit presentations, we're seeing, again, it's a template, if you will, and they're utilizing you know, kind of the 5 C's of credit to help build that narrative. But just encourage you to make sure that there's good narrative in those credit presentations, so that somebody that's new to that can pick it up and by reading through that can gain a fairly good understanding of that relationship. I mentioned risk ratings. You know, in our reviews, again, we're not necessarily identifying a lot of downgrades in the work that we've done, but we are having conversations with regard to those kind of on the bubble, if you will, those 3s and 4s, and where they should be. So you know, that's the challenge that we're faced with as an industry is you know, when is the time to move those? I think Dana mentioned is it a bad thing to get it on that watch list? You know, and maybe be a little more proactive in that regard. Certainly, by having someone else looking at it, it might be helpful to, you know, in making those decisions. Speaking to that, with regard to watch lists and problem loan reports, you know, whatever you call them, I think for the most part, when we see those, we're seeing pretty good detail, and probably in some cases maybe better narrative than we've seen in the credit presentations. A lot of those, of course, include and incorporate, you know, what the plan is going forward. We're also seeing in those areas with those problem loan reports that there's been conversation relative to incorporating covenants into the relationship, and what we've seen from time to time with regard to covenants is, should there be a violation of those covenants that we've run across, how have they been addressed? And when you start incorporating FSA guarantees or SBA guarantee, any type of guarantor situation, if you've got violation of covenants and they aren't being addressed appropriately, you know, do you run the risk of jeopardizing those guarantees? So from an administration standpoint, having covenants within a loan agreement or as it relates to some of these relationships that you're starting to see, you know, specifically capital purchases, particularly in the ag area, making sure that you're monitoring those and then responding accordingly if you're seeing any of those covenants not being fulfilled. They talked about inspections. Mike's going to touch on that more. I guess my comments were going to be similar to that, so I won't spend a lot of time on that. But we have seen where inspections have been not as current as they should be from time to time, and then the content, what the value of those, you know, what the value of those inspections really are in terms of content. And I think from an inventory standpoint, I think back in the 80s, you know, when we got examined and you had a classified credit, if you had a current inspection on there and it was detailed, they were giving you credit for that inventory, specifically in those livestock areas. What they would, you know, they were giving you, well, both grain inventory, but livestock. I remember that if you had a good inspection in there, they were going to pass on that part of the credit. So again, having timely and accurate inspections, we've run across situations where there have been inspections in the files, but you know, the quality, if you will, of those maybe haven't been probably as strong as they should be. Let's see. I guess lastly, turn it over to Mike here, but lastly, there's been a lot of conversation with regard to, and Lisa touched on it, the commissioner and others, with regard to the stress of the industry right now and the stress that the farming community is under, and rightfully so. Both physical and mental health issues are topics that I think Lisa mentioned the governor has talked about, and I know he and Ag Commissioner were in Jamestown here a week or so ago and talked extensively about it. I guess from my perspective, in addition to that being important, I think it's important for you all to make sure that you're talking to your people within your organizations about this as well, because we all know that this is stressful to the industry and to you and your organizations, and your ag lenders are dealing with these guys on a frontline basis, and they're living this stuff just as much as the producers are. So I would encourage you to make sure that your lenders are being supported, that they know that, and that you're communicating within your organizations just to give them an opportunity to share whatever those concerns are that they might have. I think that's all I had at this point, and Michael, I'll turn it over to you. I think we'll maybe do questions if there's some questions later on, but.
If questions come up along the way, let's take them as we're moving through a topic. This session is being recorded, so you can either grab the mic or give the question to Jeff. It's got to come through the microphone to get recorded. So I was here last year. I've been with the company about 1.5 years now. My title again is Agribusiness Finance Specialist. Really what we do in our area, this is a brand new service for Eide Bailey. We're focusing on ag producers, and really what we're doing in a nutshell is helping folks assemble their accrual adjusted financial statements, and then more importantly, helping them with education on what all the ratios mean, how they can use them in their operation to help better manage their operation, and then thirdly, to help communicate better with you, their lender. Getting through one renewal season, a lot of the comments that I've heard back from those that we've worked with, they really find value in knowing exactly where they're at when they come in to see you. We're doing periodic updates as some of these operations size and complexity grow. We'll be doing some quarterly and if not monthly reports for some operations. Our department has grown by 100%. I was the only one last year. I want to introduce Cheryl Lansom. She comes to Eide Bailey with 20 plus years of financial statement assembly and credit analysis, and we're really fortunate to have her on board. So going to talk through a few things. I'm not going to spend much time here. Dr. Wilson pretty much hammered this one out. One thing that I hear a lot in the countryside and from industry groups, I know the corn and soybean groups probably have a little bit more concern about the swine flu outbreak in the U.S. and what kind of impact that would have on our commodity demand for those two. You look at I know we made the comment today that we can control it. Well, one of the big differences in the U.S. with our swine industry is it's extremely concentrated. There's vertical integration, and if it gets started in any one of those chains of production, it could spread really rapid. So they're doing a lot of different things. They canceled the World Pork Expo this summer due to that, and they're trying to remain diligent in warding this off. It's an ugly deal. I'm just going to talk through, to start with here, a few of the government programs. Most of these you're probably familiar with. And then we're going to get into some of the things that I've seen. I had the opportunity to sit through 2 loan file reviews and then discuss some of the things I'm seeing from the financial statements that we're getting across some of the lenders. So again, probably well aware of what's going on here, the 2019 MFP Market Facilitation Program. A few changes from 18. The payment limitation has doubled The commitment to the program, of course, has doubled as well. Probably the other biggest significant changes is it's not based on production, bushel count, I mean. This year it's based off of planted acres. So again, the cap is 250. Right now the application deadline is December 6th. Last year the application deadline got pushed out, I think, twice. That probably will not happen this year. So if you have a producer or borrower that hasn't been in and got this done, they probably won't be moving it out because they already have the information they need to get their application moving. So y'all probably seen the maps of what the payments per county are. That's one of the other changes. The same commodities are pretty much eligible for the program, but it's paid on a per county payment per planted acre. And it really boils back to what the soybean mix is in that county. That's what this program is really all about. So one of the other big things that was a major change from last year, all government payments, you have to run through an AGI test. If you exceed 900,000, you're ineligible for government program payments. They threw this caveat in there this year that if you can prove that 75% of your income, if you fail the $900,000 test, if you can prove 75% of it comes from an ag-related business such as equipment dealership, seed sales, those types of things, they would be eligible. So if you have one of those in your portfolio, we are just about ready with our spreadsheet to run through the analysis of that, and a CPA or an attorney's got to sign off on that just like they do with the regular AGI test. So that's new, and again, right now we've got about 6 weeks till the application closes on this program. So I'm going to run through a couple slides here that kind of sets up some of the other ones I'm going to look at. Got some weather things here from the Endon site. You're probably familiar with that. Here's where we ended up. I cut it off at 10/16. Most of the sites that we're going to look at here had a killing frost prior to that. This is where we ended up with our heat units across all the stations that are available to that program. And this one here really tells a story. This is the deviation in the 2019 heat units from the prior 5-year average. Blue is bad, red is better in this case. So you get in this Jamestown down to Ellendale area, they're 300 units, heat units behind the 5-year average. I know some guys stuck some combines in the field in Jamestown over the weekend and they're coming up with moisture content north of 35% right now. So it's telling us that that crop's probably going to end up sitting out there. So when you start thinking about renewal season, dang tough to do an inventory loan on crop that's sitting out in the field. We're going to see, I think in my travels where I've been, a lot of crop that's going to be harvested this spring. So this is probably not new news to you. This is the rainfall across Highway 2 and Highway 94, Interstate 94 from east to west. The top number is this year's rainfall through the 16th, and there's some of these areas that you could probably add another inch and a half to it. But if you look at this, you know, some of these areas are experiencing twice the amount of rainfall that they normally get. And that's obviously why we see the harvest conditions and the rivers screaming down the road as well. So I'm originally from the Des Lacs area, this Berthold site. They had 20 of these 24 inches came after the 1st of July. They didn't think they were going to get a crop, and then bam, you get hammered with 20 inches. So don't know on this Can-Do one if that's how accurate that is. You all know how variable the weather can be, but I just wanted to throw this out there because I think it's going to have, the conditions that we see out there is going to have credit impacts to our producers next year, primarily in the form of prevent plant. We're already starting to do quite a bit of analysis on the areas where there's going to be excessive prevent plant for 19. We're analyzing that up against their cash rental contracts to see does it make sense to hold on to this land. Prevent plant, it's a 4-year average, so if we kick out 2015, what does that do to our uninsurable acres? So something to keep in mind. As you're aware, they did increase the prevent plant payment by 10 or 15%. 15% if you're on the HPO policy, which is what we used to call revenue assurance. And there's a $3 billion commitment out there. I know producers are already getting some of these checks. But if somebody's regular prevent plant payment is not being processed, I would encourage them to push it along, because there's probably a pretty good likelihood that they may run out of funding for this program. It's funded by WIP, Wildfire and Hurricane Indemnity Fund, and I don't know if you look at the stats, there's 19 million acres of prevent plant in the US, and $3 billion is not going to service at all. So anyhow, keep them moving forward, making sure those prevent plant claims are getting worked, and then they also had a $15 per acre cover crop payment. Lots of questions out there right now with the crop condition that we have and all the standing crop. How are the crop insurance companies going to handle this? What you see here is all the dates of the policy expiration for each crop. And what RMA has instructed their insurance providers is they're not going to make any decisions on a harvest extension until the policy period expires. So for corn and beans, it's December 10th, and you can see the rest of them. Wheat, we got one coming up here the end of October. So lots of things. I know my folks out in the Deluxe area, they've already had their wheat zeroed out that was left. I think there was 800 or 900 acres left. You look at the harvest completion on the USDA, whether or not we can believe the USDA reports or not, 95% of the wheat in North Dakota is supposed to have been harvested, but I'm not sure if that's right or not, but whatever. So anyhow, lots of things that can happen here. So what would happen if you get through to, let's talk soybeans. We get to December 10th, crop's still out there. They need to submit a claim to their agent. They're going to come out and look at it and find out from the insured if you're going to continue to try to harvest. If there's snow, they're going to do an appraisal on it and take the policy coverage off at that point. So key thing to remember is when we get to these dates, make sure that they're submitting a claim if there's still crop out. Probably well aware that the ARC and PLC sign up has begun. The sign up deadline for next year's, the 19 payment, which will come in 20, is March 15th. A lot of folks that I visit with are recommending patience right now, don't sign up. We don't know which route to go yet, and by the time we get to March 15th, we're gonna have a pretty good handle on which one of these programs will pay better for the production year of 2019. So the difference between this go around and the last farm bill is you're going to be locked into whichever program you select for the first 2 years, and then the final 3 years you can toggle back and forth. So that's new and different, but there's really no reason to go in and sign up right now because there's no payments coming for a year anyhow. So just have some patience and move forward there. All right, again, like I mentioned, I sat through some loan file reviews. Along with that experience and a lot of the different lenders that I've had the opportunity to work with the clients that we're working with for this service. And I selected these different items here to kind of talk through a little bit. So we're just going to roll on through there. Accrual accounting, I think this is probably one of the biggest areas where I think we still need to improve upon. We handed out a sheet that The Farm Financial Standards Group has put together, they did an analysis of 150 some farms in Illinois and did a 6-year analysis on it comparing accrual to cash. And those 151 farms, there was 85% variance between the two analysis methods, and in some cases up to 400%. Some of the files I've looked at, not only in the loan file reviews, but on the lender side, some folks really aren't even doing a minimum of an earned net worth analysis. To me, as the credits grow, the stress becomes more apparent. The accrual income statements is really the best way to help analyze where you're at from a perspective as a lender's position, and to help provide counsel to that borrower in helping them diagnose where are the issues. We can't really identify that on just doing a balance sheet or net worth gain. We can tell if they made money or not, or lost money. Where's it coming from? So I like to see an earned net worth done, an accrual adjusted income statement put together, and then those two statements should reconcile within 1% or $10,000 of gross income, whichever is less. And when we get to that point, that really tells us that we've got the accounting piece covered, the statements are in agreement with each other. And again, I just think for those operations that are experiencing stress or want to grow and or transition down to the next generation, we need to have this type of accounting and analysis to help really provide direction for those operations. Just to talk quick on Farm Financial Standards. Again, this was developed out of the 80s farm crisis. American Bankers Association, they began the process in 1988. Dr. David Cole was the moderator of this group. Accrual counting concept and guidelines came out of this, the Sweet 16 ratios. But their primary objectives was, number one, a universal application, but number two, more importantly, accounting standards for farm businesses. Everybody was analyzing stuff in different methods all over the place, and this is the group that they publish a report every 2 years or every 2 years and there's a committee that meets and they publish a new report on anything that they want to change. So, and I think a lot of the ag lenders use this to some degree in their underwriting. But one of the questions, I think I heard it in the General Assembly over there, that there's a lot of equity on the balance sheets. Is that what we're hanging our hat on from a lender's perspective? Are these operations really cash flowing? So, yes, this came up in there a little bit, I think, too. 80s in relation to today. What's the differences? Real estate values are continuing to hold. We have the multi-peril program that we didn't have that is a backstop for the top part of our balance sheet. Interest rate policy and government support. Again, I think when we look at some of these stress credits, what would happen if one or two of these went away? How far down the risk rating model would they fall, and how fast would they fall? Fraud, counterparty risk. You're probably well aware of the grain broker in North Dakota. We had a co-op manager in Minnesota that liked to do a lot of hunting, and we had a cattle feeder in South Dakota. 3 fairly large fraud situations inside the past year and a half. And I totally understand this is one of the toughest things to get our arms around. It's tough to underwrite fraud. I get that, but in the same breath, I think we really need to understand who we are lending our operating proceeds to for prepaids and those types of things. There's been a lot of individual sole proprietor input supply, seed dealers, those types of things put up. And we're going to have a borrower that's going to write a $500,000 check. We need to make sure that those proceeds will follow through with the product. So, Not going to spend a ton of time here. You've probably seen some of these. Some of the large mega operations have had some forced liquidations in the last couple, 3 years. Again, if you have one of these or part of one of these, do we have our documentation in place? Have we done the inspections? Do we have all of our due diligence done? And I think this is kind of somewhat of an alarming stat, that 10% of the ag producers hold 80% of the ag debt. So when they do fall, they can fall fast and hard, and the biggest issue for the lender group, it can be devastating to your clients for loss reserves. So, balance sheet verification. I've picked up several files where there's been several entities that have been developed over the past several years for various reasons, whether that's FSA or transition or what have you. But a few of the balance sheets that I looked at, we actually went in and did title searches on all the real estate because nobody knew who owned what, and that's fine if it's not on the right balance sheet as long as you have everything cross-collateralized and personal guarantees and all that. So something to think about on when you look at your portfolio and there's 4, 5, 6 different entities, do we have the balance sheet that we think we have? Something to look at. Move on from there. Inventory, I know this was mentioned over there, lots of buzz in this area right now. It just seems like whenever we run into a stressed operation, we're going to end up with inventory deficiencies. It just 9 times out of 10, it always happens. We just got done putting together a little article on some thoughts on how to manage inventory from a collateral perspective, and we can certainly get that out to you guys. It's just some housekeeping things to help manage it. This is one of the toughest areas to manage from a loss reserve. You guys place a lot of trust when you extend credit for operating in the character piece of that operation, and this is generally the first place that we see losses. So, farm inspections, like Jeff mentioned, farm inspection needs to be more than just a farm visit. Got to have documentation, how we arrived at values, if we're the ones that are actually doing the valuation, or do we need to start thinking about hiring a third-party outfit to come in and do those appraisals on larger credits and maybe ones where you think you might have some inventory issues. Do we need to start considering that? Have a short video here of one of the clients that I worked with last year. We'll play this quick and then we'll get into some questions if you have any.
Time is money in this business. Sometimes you have to make a decision like really quick and you need a response like that. We want quick response times and quality work. I was so excited when they offered this financial advisory service. I just think it's really needed in the industry. So it's 4th generation farm. My great-grandpa homesteaded here from Germany in 1888, so it's been in the family a long time. Today, with the amount of money that it takes to run a farm, 1% in interest is a lot of savings in a year. And that alone is a big deal. That, last few years we've had some really tight margins, been eating away some working capital on our cash side, and we've had our lender that currently had raised our interest rate, over 1% because of our working capital, even though we had a good debt-to-asset ratio. So I was a little concerned about what they were doing, and we always try to really organize our books on that side when we come in. But it's always nice. I felt like it'd be nice to have somebody else in the room that was a specialist, kind of have a third party, so that kind of helps you maybe make a case or bring up questions that you can't think of at the time, because it is a little intimidating when you're asking for a large amount of financing in these situations. Assemble a portfolio is kind of like a resume for us, which has really helped us, and I'm really happy with what we did there. And in the long run, it's going to save us a lot of money too. And the experience that the personnel have there, their history, if it's in ag lending or or how many years they've been doing accounting, or just their experience, and that they have knowledgeable staff. So if they don't have the answer, there's many people, they're a big organization, they'll find somebody that's had that experience and can find the answer for you. We've been with Eide Bailey for over 20 years, and that speaks for itself.
Any questions? Back here, Jeff. Back here.
At the Governor and Doug Gehring's meeting on Monday night, one of the questions that came up was the issue of crop insurance on if you can't harvest the crop this year, not being able to get PP on that land in 2020. What is your experience, and what do you tell customers that are facing that dilemma?
Well, there's a couple different factors there. If you're the same tenant as you were the prior year, or this year, and you're the same tenant as next year, that should be eligible for prevent plant, providing you meet the 4-year rule. So the prevent plan is, they take the 4 most recent production years and calculate out how many acres, what's the highest acreage that you planted. Now, if there was some land that just sold in Jamestown yesterday, it's full of corn, still standing there, it's gonna be a new owner, that ground should not be eligible for prevent plant for next year.
See, one of the companies didn't do that in prior years, and one of the crop insurance companies, and that's some of our clients are asking that question, and their agents have already told them, even if it's your own land or you're not going to qualify.
Well, I'm probably gonna have to go like this because I am a licensed crop insurance agent, but I haven't sold multi-peril in probably 10 years. So, like I said, though, there is a lot of analysis being done on that right now. Folks trying to look out into 2020 and what does that math look like, projecting out a multi-peril price of $4.25 on corn or whatever. Does it make sense for me to keep this ground? So.
Well, let's see here. I've got, yeah, okay. Well, I think we'll wrap it up. If there aren't any other questions, I do have your
Code.
CPE code for you somewhere. Loan. Well, thank you guys for being here. We appreciate your attendance, and I hope you have enjoyed the day. Enjoy the rest of the day, and safe travels.
One down, 4 to go.